This isn't just a trade. Think about what this means. This is a confession. On December 9, 2025, a report surfaced that should have stopped every financial news outlet dead in their tracks. JPMorgan Chase, the very same bank that paid a nearly $1 billion fine for criminally rigging the silver market, has allegedly spent over $22 billion to do the one thing they spent decades preventing: cornering the physical silver market. This isn't just another bet. It's a declaration of war, except they've switched sides. Market reports claim the bank has done the unthinkable. Between June and October of 2025, they allegedly unwound their entire massive paper short position, and they didn't just exit. They went on the biggest physical silver buying spree in modern history, 750 million ounces. That's not a typo. 750 million ounces of actual physical silver, real metal in real vaults. This is the emergency broadcast. The era of paper suppression is over, and a violent repricing of silver may be imminent. In this video, we're going to expose this monumental bet. We will separate the sensational reports from the hard, verifiable data. We'll dive into the court documents, the exchange data, and the history to understand what this seismic shift truly means for your money. To get the sheer audacity of this, you have to understand JPMorgan's history. This isn't some benevolent player. This is the market's biggest predator. For years, precious metal circles pointed the finger at JPMorgan, accusing them of using colossal, manipulative short positions in the paper market to crush the price of silver. For a long time, this was just a conspiracy theory. Then the truth came out. In September 2020, JPMorgan was hit with a staggering $920 million penalty. This wasn't a slap on the wrist. It was the largest fine the CFTC has ever handed out for spoofing. The bank admitted to wire fraud. Let's be crystal clear on what they did. For at least 8 years, from 2008 to 2016, traders on their precious metals desk placed tens of thousands of fake orders for gold and silver. They had no intention of executing them. They would flash huge buy or sell orders, creating a false illusion of supply or demand to trick other traders. Then, at the last second, they'd cancel the fake orders and place their real trades, profiting from the chaos they created. The Department of Justice prosecuted their head of precious metals, Michael Nowak, and his top trader Greg Smith under laws typically used for organized crime. Both were convicted and sentenced to prison. This was a criminal scheme that generated enormous profits for the bank. So, when we talk about JPMorgan, we're not talking about a neutral party. We're talking about a convicted market manipulator. They were the undisputed villain of the silver market, but according to these explosive new reports, the villain has just switched sides. Now we get to the event that sent shockwaves through the market. In 2025, reports began to surface, amplified by a stunning piece in the Economic Times making jaw-dropping claims. First, JPMorgan allegedly unwound its entire paper short position, a position some estimated to be 200 million ounces. For years, that short position was the mountain crushing the silver price, but they didn't just exit the market. The second, more stunning claim is what they did next. The reports allege JPMorgan went on a buying spree of historic proportions, accumulating an unprecedented 750 million ounces of physical silver. Let's pause and comprehend that number. 750 million ounces. Global annual silver production is around 835 million ounces. That means one bank has, according to these reports, acquired a stockpile equivalent to nearly an entire year of global mining output, a hoard valued at over $22 billion. This would be the largest private stockpile of silver in modern history. According to these accounts, this mountain of metal was amassed using COMEX exchange vaults, and JPMorgan's unique role as custodian for the world's largest silver ETF, the iShares Silver Trust, SLV. As custodian, they safeguard the physical silver that's supposed to back the ETF shares. The line between their metal and the EFT's metal can get very blurry. If this is true, the market's biggest bear has become its biggest bull. The poacher has become the gamekeeper. The bank that paid nearly $1 billion for pushing the price down has now reportedly made a multi-billion-dollar bet on the price going up. The question is, why? The why is a story in two parts. First, the bull case for silver that JPMorgan's analysts would have seen coming years ago. Second, the investigation, where we must pump the brakes and separate the spectacular claims from verifiable data. First, the motive. The bull case is a mathematical trap. For years, the silver market has been in a structural supply deficit, meaning the world consumes more silver than it mines. Projections for 2025 show another deficit, the fifth consecutive year, with the total shortfall since 2021 approaching 800 million ounces. This isn't just about investment. The real story is a three-headed industrial demand monster: solar, EVs, and AI. Industrial use is now over half of all silver consumption. Solar panel demand is exploding. Electric vehicles use far more silver than regular cars, and the AI data center boom requires massive amounts of silver for components. Demand is locked in. At the same time, supply is struggling. You can't just flip a switch for more silver. About 70% of it is a byproduct of other mining. Rising demand plus flat supply equals a classic squeeze. JPMorgan saw this coming. But this is where we must act as analysts, not just storytellers. Is the 750 million ounce claim true? Let's look at the official data. According to the latest numbers from the CME Group for the COMEX exchange, JPMorgan's vaults hold approximately 196 million ounces of silver. That includes their own metal and metal held for clients. While this makes them the dominant player, controlling nearly 43% of the exchange's inventory, it is a far cry from the 750 million ounces. What about the SLF ETF? As of November 2025, the SLV Trust held about 517 million ounces. JPMorgan is the custodian, but it is crucial to understand that silver is owned by the ETF shareholders, not JPMorgan itself. Now, could a bank with such intricate control over the market's plumbing use its position to its advantage? Absolutely. But custody is not ownership. The sensational claim of a proprietary accumulation of 750 million ounces is, right now, unverified by primary sources. It remains a powerful market rumor. The core truth, however, remains. The convicted wolf is guarding the henhouse, and the henhouse is running out of chickens. Whether the number is 196 million ounces or a secret 750 million, JPMorgan's pivot from price suppressor to physical accumulator changes the entire game. This brings us to the inevitable comparison: the Hunt brothers' attempt to corner the silver market in 1980. The Hunts, two oil billionaires, saw inflation coming and used aggressive, leveraged futures contracts to drive the price from $6 to nearly $50. But their strategy had a fatal flaw. They were over-leveraged in paper markets. The exchanges and regulators simply changed the rules mid-game, raised margin requirements, and trapped them. Their position collapsed, and the price of silver crashed. This is the ghost that haunts the silver market. But this is precisely why what JPMorgan is doing is so much more dangerous. First, JPMorgan is not the Hunt brothers. They aren't outsiders threatening the system. They are the system. Second, the strategy is different. The Hunts relied on borrowed money and paper leverage. The reports on JPMorgan emphasize they are accumulating physical metal with their own cash. You cannot be margin called on physical metal you own outright. They are insulating themselves from the very weapon used to destroy the Hunts. Third, the market is fundamentally different. In 1980, industrial demand was a fraction of what it is today. Today, the squeeze is being driven by an insatiable industrial need from multi-trillion-dollar industries. Companies like Tesla and Apple need physical silver to build their products. They can't just settle for cash. This creates a non-negotiable demand that did not exist in 1980. JPMorgan's move is a confirmation of this thesis. The suppression game, mathematically, is over. They are positioning themselves for a world where the physical price of silver decouples violently from the paper price. They rigged the game on the way down, and it appears they are now rigging it for the ride up. Let's bring it all together. We have a bank, JPMorgan, with a criminal history of manipulating silver. We have sensational reports that this same bank has made a historic pivot, hoarding an unprecedented amount of physical silver. And we have the verifiable facts of a severe and deepening structural supply deficit driven by unstoppable technology megatrends. The ultimate takeaway is not whether the 750 million ounce figure is precise. The takeaway is the direction of travel. The smartest, most powerful, and most manipulative player has decided the 40-year era of silver suppression is over. Their actions suggest they are preparing for a major repricing event, an event they now stand to profit from immensely. This is the signal. This is a monumental shift. It's a confession that the case for silver is no longer something they can suppress, but something they must own. The bank that made billions shorting silver for decades just deployed billions to go long. They're not making a speculative bet. They're positioning for transformation. It's crucial to remember, when the wolf joins the sheep, he isn't there to eat grass. JPMorgan is not your friend. They see the tidal wave of physical demand coming, and they have positioned their surfboard to ride it. The question you must ask yourself is not whether the wave is coming, but whether you'll be positioned to ride it or be crushed by it.